If investing were easy, we'd all be rich. But for so many people, it just feels like this frustrating cycle of losses. The really surprising part? It's not about bad luck. It's about a series of totally predictable mistakes. So today, we're going to dig into the 12 pillars of rational investing. These are the core principles that separate the winners from the losers, all by helping you avoid those exact mistakes.
So what's the real problem here? It's actually fascinating when you think about it. Success in investing has way less to do with being a genius and a lot more to do with just avoiding the common human errors that trip up even the smartest people out there.
And this is the question that's really at the heart of everything. I mean, we have more information, more tools than at any point in history. So why do so many investors still completely fail to build real long-term wealth?
Well, here's the big insight. It is not random. It's a pattern. Investing failure is basically a behavioral loop, a series of traps we just fall into over and over. So the key to winning isn't about being brilliant, it's about learning to spot those traps and sidestep them.
Okay, so here's our roadmap for today. We'll start with that universal problem we just talked about. Then we're going to group these mistakes into two big buckets, the traps in your mindset and the flaws in your strategy. And finally, we'll lay out a clear, rational path to move forward.
Let's start with the toughest opponent any of us will ever face as an investor, ourselves. These first few pillars are all about mastering the psychological game, those biases that cloud our judgment and lead to some really costly decisions. Which brings us right to our very first pillar. You have to conquer confirmation bias. Our brains, they love being right. So once you decide you like an investment, your brain goes on this little mission to find all the evidence that proves how smart you are, while conveniently ignoring all the warning signs. It's a really dangerous echo chamber.
And this is the key. You have to completely flip the script. The best investors don't try to prove themselves right. They actively work to prove themselves wrong. They go looking for the negative case. They welcome different opinions because killing a bad idea before you put your money in it, that's the cheapest lesson you will ever learn.
Pillar number 2 is all about learning to resist the herd. Markets move in this really predictable emotional cycle, right? Greed totally takes over at the top, and fear just dominates at the bottom. And sure, following the crowd feels safe in the moment, but the herd is almost always running in the wrong direction, buying at the peak of excitement and panic selling at the bottom of despair.
Now, for pillar number 3, we have to learn to ignore our entry price. This is all about avoiding that emotional trap called anchoring. We get so attached to the price we paid for something. We tell ourselves, oh, I can't sell it for a loss, or I'll just sell when it gets back to what I paid. But here's the hard truth. The market could not care less about your personal history with a stock. Your entry price means nothing for its future.
To break that emotional anchor, you just have to ask yourself one simple but really powerful question every single day you own something. If you weren't willing to buy this stock with fresh money today at this price, then why on earth are you still holding it?
Okay, so we've covered the mind games. Now let's shift gears and talk about the flawed strategies and the analytical mistakes investors make when it's actually time to pull the trigger.
This brings us to pillar number 4. Focus on the business, not the forecast. One of the biggest mistakes people make is trying to be a fortune teller. Look, trying to predict the market's next move is a fool's errand. So instead of trying to predict the unpredictable, put your energy into what you can actually analyze. Is this a great business, and am I getting it at a faux price?
I absolutely love this metaphor because it just nails the idea. Don't waste your time and energy trying to be a weather forecaster for the market. It's impossible. Instead, become a great shipbuilder. Focus on owning stakes in really resilient, high-quality companies that are built to weather any storm that comes along.
And pillar number 5 is to embrace simplicity. We think we get extra points for solving really difficult, complicated puzzles. But in investing, that usually gets you punished. The best returns so often come from simple, boring, easy-to-understand businesses. It's all about focusing on those one-foot hurdles you can easily step over again and again.
Pillar 6 is a really simple rule, but it's so important. Avoid leverage. Using borrowed money is like pouring gasoline on a fire. Yeah, sure, it can amplify your gains, but it magnifies your mistakes exponentially. A single margin call can wipe you out completely, forcing you to sell a great company at the absolute worst moment. Remember, survival is always rule number 1.
Now, this next one might sound a little counterintuitive. Pillar 7 is to practice concentrated conviction. We're always told to diversify, diversify, diversify. And yeah, that can protect you if you don't really know what you're doing. But if you have done your homework, spreading your money across too many different things just guarantees you'll get average results. It totally dilutes the impact of your very best ideas.
It's a pretty powerful reminder, isn't it? You don't need hundreds of good ideas to build serious wealth. You just need a few, a small number of truly great ideas that you understand inside and out and have the guts to hold on to for the long run.
And the 8th pillar in this strategy section is to demand a margin of safety. It is so easy to fall in love with a company that's promising to change the world with explosive growth. But if you pay way too much for that future promise, you've already lost the game. Real investing is about buying that growth at a reasonable price, leaving yourself a nice cushion just in case things don't go perfectly.
All right, so we've laid out all the traps, the psychological ones and the strategic ones. Now, let's bring it all home. What does this rational path forward actually look like in practice?
This leads us to pillar 9, and it really confronts the one mistake that sits underneath all the others. You have to play the long game. We get so rattled by short-term market noise, and we let our emotions completely take over the plan. It's like planting a sapling and then pulling it up every single day to see if the roots are growing. Impatience is the absolute enemy of compounding. Time is your single greatest asset, but you have to let it do its magic. And that brings us to our final 3 pillars, which really form this simple, powerful framework. Pillar 10, stay patient. Let time do the heavy lifting for you. Pillar 11, stay rational. Don't let fear and greed be your co-pilots. And finally, pillar 12, focus on owning great businesses, not just renting stocks for a little while.
And maybe the most empowering part of all this is that success in investing isn't really a battle of IQ points. It's a game of discipline. It's about having a solid process and simply avoiding those big, unforced errors that sink almost everybody else.
So as we wrap this up, I want to leave you with the question. Now that you've seen all these common traps laid out, which one really hit home for you? What is the one behavioral change you can commit to, starting right now, to put yourself on a much more rational path to success?